Hello everyone. I want to welcome you to today's webinar, RMA Valuation Edition, Better Financial Statement Benchmarking. ValuSource is pleased to provide this webinar today. It's a free webinar to learn more about this database. A couple pieces of housekeeping as we get started here. The first is there's no attendance and there's no polling questions here. So continuing professional education, there's not a certificate for that. Just wanted to make sure that that was clear up front. Not really providing continuing professional education credit today on this webinar. Hope you stick around to see how the RMA Valuation Edition works though. If you have any questions, feel free to type those into the Q&A panel, and I will try to look at those as we go through the presentation and deal with those as close to the time of the question as we can. And feel free to ask questions. So I have one question already, and it's a great question. I forgot to put this into the general thing. Are there any handouts? Zoom does not allow us to push handouts into a, what do you want to say, a navigator where you can download them. So I am planning on either sending them out tomorrow, or if I can't send them out, we have somebody I'm working with that will send them out Monday. If you have not heard back from me by Tuesday morning, please send me an email and I will be happy to send you the handouts. The handouts would include a slide deck of what I'm showing you here, as well as the front portion of the RMA 2019-2020 edition. And I'll tell you why that front portion is important here as we get a little bit, as we get further into the presentation. My name is Dave Miles. I'm a CPA, CVA, and I've been the Business Valuation Manager at ValuSource for the last 20 years. I'm the on-staff CPA. I act as that go-between between the marketplace and the programmers and say, here's what the marketplace is saying they need, and the programmers are saying, this is what I can do. And hopefully in between there, we deliver some great products. Today, we are talking about the RMA database. And for the last 20 years, I've been responsible for making sure that the data that the RMA gives to us, it's published and put out there in a way that can be used. And so that's why I'm here today. And let's talk about why we need the RMA. So, well, let me give you an overview first. We're going to talk about why we need the RMA, what problems does it solve. I always like to talk a little bit about the history of the different data sets. And so I'll talk to you a little bit about how the annual statement studies were put together, why they exist. We're going to talk about what's special about the Valuation Edition. And when we get to that, it's going to be about the p-tile, the percentile. And I think the percentile is something that's underutilized sometimes. And it's not just for this type of work. You can also take other data sets and cut them up into percentiles and do the same sort of math on it. We're going to talk about where in the process this is used. It's a little bit on the basic side, but we will talk about how that is important. We're going to talk about how credibility is enhanced or not enhanced depending on how you say things and what data you use to put that into place. What's the empirical data you're using to develop your opinion? And in today's environment, today's litigation environment, more and more we're being asked to say, here's the data, here's how it compares to the subject company and why I should be using it, here's what it says about the subject company. And so, when we get there, we'll talk about how that credibility may be enhanced using RMA data. And then I will show you a demonstration, go out to the website and say, here's how I use it, give you a couple little tips on that. So let's look at why we need the RMA data. So here's the issue is if we go out and I was looking at the ValuSource market comps, formerly IBA data, and I look at restaurants or I even look at the whole database, I can get a price to seller's discretionary earnings multiplier with a 300% point swing between those two. In other words, one would be a 2 times and another one would be 6 times. And why would your company be at the 6 times mark and why would your company be at the 2 times mark? Or do you just go in the middle and say, it doesn't matter, my company's just a company and so we're just going to pick the middle mark? And so that's the issue that we're really looking at. When we're trying to provide empirical data to justify why we lift a price up or why we push a price down, the benchmarking of the subject company is something that we go through really quickly, but I think it provides the empirical data you need to drive that company specific risk up or down a little bit. Or in the case of a market method, I'm going to drive the multiplier up or I'm going to drive the multiplier down. So I think it's a great factor in making your judgments about a company's cash flows. So obviously, you know, you're looking at a particular company and you're seeing that they're spending more on officers' compensation than other companies in that same range. Maybe you can look at that and say, look, their operating expenses are a little bit high here. Have I accounted for that in the cash flows? You can look at it from that viewpoint, and it's not just that particular line item. You can go through some of the other ones and see where that might be at. I believe that RMA is a source of data that describes a company and how it sits in the industry. And that's the important part, how it sits in the industry. And if we consider the RMA as the population that I'm comparing myself against, we're going to have some really good data come out of that. We'll talk a little bit about other data sources as well here. And if you have questions, like I say, feel free to type those into the question panel. Okay, let's talk about the RMA. Originally, the RMA was named the Robert Morris Association. Back in 1915, 1914, there'd been a recession. There's been lots of bank runs, and people were saying, hey, we've given all of this money to companies. Those companies are going belly up. How can we reduce our credit risk? How can we make this a safer environment? This is the same time frame where we are also seeing the creation of the Federal Reserve System. So, you know, we're getting together, people are saying, let's get together in groups, let's try to manage some of this stuff and just not let it run willy-nilly over the top of us. So in 1915, a group of bankers got together and started to exchange information, and they called that group the Robert Morris Association. There's a couple years inside of there where they were saying Robert Morris Club and that sort of thing. But recently, this year, 1919, is when the RMA is celebrating its 100th year. So, you know, it's been around for 100 years. 1919 is when they're going to say is the official start date of the RMA. We might ask ourselves, why is it called the Robert Morris Association in the beginning? Robert Morris was the financier of the American Revolution. So in my opinion, you had George Washington, and then you had the guy providing the supply chain. Here's the guy providing the uniforms, the bullets, the guns, that sort of information, or that sort of resource to create the American Revolution. Robert Morris put that together, put together a bank, made the deals with the Europeans inside of there. So he was actually that person. He was one of only two people that signed all three American documents, the Declaration of Independence, the Articles of Confederation, and the Constitution of the United States. The other person, I think, was Roger, I don't remember his last name, out of Connecticut. But only two people signed all three of those documents. And Robert Morris was one of those. The reason I mention all of that information is because in 2000, the RMA changed its name to the Risk Management Association, keeping the initials RMA. I believe that they made that change because it had more of an international flavor. They wanted to start to look at other countries, other regions, and say, look, you know, we're a risk management association. Let's get together, let's exchange information. And so they kept the initials, but changed it off of Robert Morris because Robert Morris was very tied to the United States. After the year 2000, you know, they've grown, they're put together. Their headquarters is in Philadelphia. And what do I want to say? I want to say that you're welcome to go out to look at rmahq.org. They have a lot of good information out there, especially if you go into their products and you go into the RMA statement studies. In fact, that's one of the competitors with this particular information. And when I get to that area, I'll talk about it a little bit more. The idea, though, is that the loan officers put together from their clients, here are the financial statements that are being given to us, and they aggregate those financial statements and then produce the annual statement studies. And they've been doing that for 70 some odd years. Obviously, they've been exchanging information for 100 years. It's probably a data source, I think, that's older even than the SBBI data that we use, or it's not SBBI, it's CRISP data now that Duff and Phelps has it. So Roger Sherman from Connecticut signed all 3 documents. You're absolutely right. That was his last name. Thank you so much for that. Back to my point, loan officers are collecting this information. These are based off of real companies, and that information is put together and aggregated. And when we get to the weaknesses of the data, one of the weaknesses is if they don't have enough information to publish a large enough slice, they simply don't publish it. And so you may not get information for everything. But on the other hand, these are real companies, they're operating companies, and there are companies that people are looking at and reviewing and saying, is this really happening? And that's what's going on there. When we get to some of the data points, I'll talk about this loan officer importance again, because a loan officer has a much different take on this data than perhaps a evaluator does. So in the 2018-19, now November 1st, we just had the 2019 data come out, so I have not updated my numbers. This would be last year. I counted 296,000 statements without the percentage of completion. I counted 776 industries or separate NAICS codes. I believe that went down to about 740 or 750 codes. There was a few less codes this year, and I counted about 218,000 statements with less than $10 million in revenue. My point I'm trying to make is that there's a large sampling here, there's a lot of industries here, and there's a lot of industries with very, very small, what I call super micro businesses. If you look at the micro cap in the, the S&P or the publicly traded micro cap, the bottom 20%, those are pretty large compared with this. So if we go to super micro cap down here in this $1 million, $2 million in revenue businesses, where do you get data to compare at with those? One of the places is the RMA. You got 218,000 out of the 300,000 statements, give you an idea of where that's coming from. That's what I counted. I will be happy to update those in a little while. There's a question out here saying, is there any plans on expanding the percentage of completion beyond construction? Now, I am not the RMA, but I'm going to hypothesize, I'm going to pontificate that they would not expand that, because what they're doing is they're working with the trade association to get that percentage of completion data. And by working with the trade association, they can get that data easily. I'm not sure that the engineering industry has the same sort of thing. And that's why I'm pontificating and saying no. Have another question here, probably not the right time to talk about this one here. Why is only the median shown for some data? And hold on to that question when I get into the way we cut up the data. I'll try to answer that. If I don't, please type it back up inside of here. Okay, so the real question in our world, in the valuation world, where we're trying to compare a subject company against a benchmark, and I shouldn't call it valuation, there's also, all the other things that we do out there. But when we're trying to benchmark a company, say, is this good or bad inside of the industry? Is it strong or weak? We have to ask ourselves, where is this data coming from? In our world, we tend to use databases that were not built specifically for valuators. In fact, the only database I'm aware of, one database I'm aware of, that's Pratt Stats or Deal Stats, was built for valuators specifically. The discount information that we get from Duff and Phelps is a sidebar of that, and we can kind of say that this was built for the valuation community, but really it was put out of a book called the Classic Edition of SBBI, which was put out to asset managers trying to say what asset classes are the best to put the money in. And we kind of hijacked that over to the valuation community, and then they split off a Valuation Edition from that. And that's where that came from. So maybe those two, but this other data isn't necessarily for valuators. And so you have to ask yourself, where does this data come from? You know, what's the process to obtain those numbers? Are the numbers biased? How granular is it? Strengths, weaknesses? And is the data relevant to the subject company? So here's the time where I want to talk about other data sources. Obviously, we're talking about the RMA data, so I'm going to save that one for last. But there's a data source out there called the IRS corporate ratios. What that data is coming from are the Form 1120s. So there's a statistical sampling that the IRS puts together of all the tax returns. And based off of that statistical sampling, you can calculate the ratios. What's the problem with that? Well, that sampling takes 3 years to go through. In fact, they just published the 2014 data, and it's not in the same format as it was before. And so, you know, it's a little bit on the stale side. Let's talk about another one. We talk about Integra data or microbilt. Well, microbilt has an economic model where they put all of these data points into it and they kick out, you know, numbers for all the ratios. That's really good in the sense that there's a ratio for everything. There's an economic model there. But just like when we forecast numbers and we try to project numbers and say, here's what the future is going to look like, when you backcast, and that's the word it's called, when you backcast an economic model, it's saying this is what history should have been, not necessarily what it really was. And so you might have a discrepancy in that, and you also have to be careful about the model that's being used there. And some things can look normal, and you know, there's just coincidence that they're normal, as opposed to necessarily saying this is how it was. BizMiner is another big data provider. They also use an economic model to put their data into place. And so you have to ask yourself, what's the model that's being used, and how am I judging these numbers? Is it, you know, how granular is the data? Are the numbers biased in some way? You know, is it transparent on how they get those numbers? That's where those are the questions that you need to be asking. Profit Sense, that's with a C, also has some good data. So you go out there, you type in the data from your subject company, goes into their system, they do their stuff on it, they kick out a report and say, here's what your numbers are, as well as, hey, your quick ratio is too low, you need to beef it up a little bit, and give you some ideas on that. The thing with Profit Sense, being a CPA, is that I have to make sure my engagement letter says that it's okay for me to type those numbers inside of there. When I was talking to a member of the ethics committee, they said giving data from your client into a database that aggregates things is not allowed unless you have specific permission from that client. Just for 2 cents, that's what's out there, that's what's going on. So that's Profit Sense. I may have missed some other ones out there, but the RMA. So you can get RMA from, I want to say, 2 different sources. You can go to RMA directly, rmahq.org. They have an online product, and they have all of the same data that we have, except for this p-tile information that I'm going to talk about. You can also bundle those inside of your subscriptions with key value data, or you know, with ValuSource, and you can get different levels. Here's the current year data, here's multi-year data, here's data, you know, with the p-tiles that I'm going to talk about, and then I think they have an ultimate package too that says, okay, you can get everything that we have. And you know, so I'm going to try to talk about why that p-tile information, why that RMA data is better than others out there. Like a good CPA, I'm going to talk about the weaknesses of the data first. And so this is data for loans. The loan officers are looking at this data. They're trying to judge their credit risk. In other words, if I give this company money, what's the probability that I'm going to get repaid? And I want that probability to be at least normal, if not high. And so, you know, that's what they're looking at. And when I get into cutting up the data, I'll mention it again. But one of the questions you have to ask yourself is does your company have debt or no debt? And are you going to account for that? Does it make a difference on some of those returns on the income statement and items like that? And I have a question or something coming up here. Give me a second. There it is. So I have somebody saying highballing, and I'm guessing that means that, yeah, you know, somebody's probably going to window dress their financial statements so the loan officers look at that and say that looks good. You know, I believe that some of these are coming from, you know, companies that exist and they're trying to keep their covenants current. In other words, how are you doing this year? And so they get the financial statements in that way too. As I said before, there are limited samples of data and you don't have all the industries that are out there. You don't have all the slices of data that's out there. And so you're going to have limited samples and data, which means that you're not going to have a number for everything. That's one of the advantages some of those backcasting models is that if they don't have numbers, they just tend to put them out there anyway and say, this is what the number should have been. And it's one of the issues that I have with that particular backcasting process. We also have a problem with the RMA data is that the definitions are not as specific as those valuators, litigators, fraud people want. Some examples are officers' compensation. So officers' compensation is buried deep inside of an operating expense, you know, one line operating expense for the income statement. And then when you get into the ratios, there's one number and it says all officers and directors. So, you know, we want to try to pull out one officer. Well, you can't compare those two. That's apples to oranges and it just doesn't exist. We want to have depreciation expense pulled out and say, okay, what's your depreciation expense so I can get some idea if I'm normal in that area of my cash flows. And the answer is that information is not available. Some of the other issues people look at and say, is this a cash basis statement or an accrual basis statement? Am I comparing apples to apples even inside of the industry? And we don't know the answer to that. You do know what types of statements are coming out. You know, are these ones prepared by the internally? Are these reviewed by a CPA? Is there an unqualified opinion on this? You can see what that is. But like I say, is this a cash or accrual basis? We don't really know that. Is this a public company or a private company? That could make a big difference. Obviously, when we get into the smaller companies, less than $10 million, you know, almost always are going to be a private company. But some of those larger slices, you know, they could easily be a public company. Operating expenses are not broke. Oh, another one that's out there too, is this international companies or is this, you know, just American companies? And am I comparing myself to the correct geographical region? And that is, you know, that's a valid point. As RMA is getting bigger, we have to look at that. What I can say is that today, most of these statements are coming from American companies and they are coming from, you know, subsidiaries that are on American soil doing business in American dollars. So there is that. I think I talked about the operating expenses not being broken down and how that works. You know, depreciation expense, rent expense, and we talked about officers' comp. So there is some weaknesses with this data. It's not as specific as we would want. What are some of the strengths of the RMA data? Real financial statements, real company, and the data is not a statistical sampling or a model. In other words, we're not removed from reality in any of this data. It is very real, and it is from companies out there that are operating. And obviously, you know, somebody said they were highballing on their financials. Yes, you can window dress a little bit, but you know, if you lie on these forms, there's a lot of things that can happen to you. So I'm guessing that they're not, what do I want to say, really outlandish. So there is that. As I said, with backcasting, you can get information and you can get a number for everything, but you have to ask yourself, how real is this? Does it really make sense? I also believe that the transparent collection process for the RMA data is a very good strength. And by this, I mean, we know how the data goes from the client to the bank to the aggregator. We have an idea of how that aggregator pushes this data out and then gets delivered to us. We know what that process is and we can look at it. While we may not be able to go and say, oh, that was this company, and this company inside of this sample, and so now I can get this, we do know how the data went along the collection process. And that transparency is important because sometimes when you don't know the model that somebody's using, it becomes a problem. And so that's one of the issues that I have with the companies that use economic models is I haven't seen one that says, oh, by the way, here's our model. And you know, that would be selling their business secrets. But it's hard for me to say, is that a valid model or not? Obviously, the numbers that come out of it are usable. Everybody uses them. So you do have that, you know, what is it, reliable and, you know, usual means of getting data. I forget what the term is out there. I also like that there's a history of quality data here. So in other words, they've been producing this for 100 years. And as they produce that for 100 years, they've lasted the test of time. And that is a good thing. And I don't think that people necessarily put that down when they're describing, why they're using the RMA data as opposed to another data source inside of their opinions. Now I'm going to go into the Valuation Edition. I believe the Valuation Edition has a granularity that you don't get in any other data set. And we're going to talk about what that means and some weaknesses with that granularity as well. So what do you get inside of the RMA data? I think we're all aware that we get the common size balance sheets, we get the common size P&L. And what those are is percentages. Those percentages are averages. And one thing that comes out of the ValuSource stuff is that we actually extend those out into dollars. So you can see what a dollar sign balance sheet and income statement looks like. And that is a good thing, because sometimes, like I say, somebody like me, a CPA, seeing those numbers makes more sense to me than sometimes seeing just the percentages. So you get to see that. Those are averages. You get 19 common ratios, and as you look at those common ratios, and that's why you need the front part of the book, is you need to know how those are calculated. Is it based off of the end of the year, or do you take the beginning of the year, end of the year, average the two, and then take that into the income statement number to find out what your ratio is? It's important to know how those are calculated. It's also important to know how those are defined. You need to know that some of these items are nonlinear. That'll be important when I talk about how we calculate the p-tiles, because if nonlinear item can't be split into 10 pieces. But if you look at sales to working capital, fixed assets to net worth, and debt to net worth, those go from, and if I remember right, they go from the lowest negative to the highest negative, and then they go from the lowest positive to the highest positive. So basically it goes from like minus 2,000 to minus 2, hits 0, and then it goes from 2 to 4,000. And that's not necessarily, well, it goes the other way around. Minus 2 to minus 2,000 hits 0, and then it goes from like 0 to 1,000. And so it's not linear. It doesn't make sense. It goes from, like I say, you have that negative part of the ratios that don't work. And so when you're looking at sales to working capital, fixed assets, net worth, and debt to net worth, you need to look at those and realize that they're nonlinear. As I said, part of the handouts is the introduction. If you don't get that, my email will be up at the end of the presentation. I'll be happy to make sure you get that. One of the nice things about the RMA data is that it cuts it up into data slices. You can go out to RMA HQ and still get all of this information, data slices and that other stuff. The M is a banker's term for 3 zeros. So 0 to 500M means 0 to 500,000. 500,000 to 2MM means 2 million, because there'd be 6 zeros there. The M is just a Roman numeral for 3 zeros. It's been in the banking industry for years and years and years. There's 5 years of data that's presented in the historical slice, but that 5-year historical slice are over the last 5 years. And so you need to be careful of that, because you can't compare that historical column with a slice of data column. In other words, if the size of the company is split up into sales of 1 to 3 million, and you're trying to say, oh, I don't really have a number here for, say, officers' compensation percentage, but I do have one over here in the historical number. You go over there and you pull it out. Those are not comparable, because you're talking about every company inside of the data set, not just that particular slice. I'll give you an example of that here in a minute. The construction area is the completed contract. Construction area is the percentage of completion, and you get completed contract versus percentage of completion, and you also get regions. Those regions are Northeast, Southeast, Central, North Central. You only get national in the standard edition, and obviously the price for the standard edition is a lot less than the ultimate price for all of the years, and also for the other ones. But like I say, you do get regions inside of here. That means that if there's a regional discrepancy, you can pull that out. The best example I have of that is I believe it was in the early 2000s or maybe the late 1990s, when the textile industry in the South started moving all of their plants to the to the Caribbean and to Mexico, and so there weren't as many people making things anymore. But up in the Northeast, you know, that was not the problem. They didn't have that issue, and so by separating out the Southeast from the Northwest, you could find what some of those regional differences might have been, and that's the example I use in that. Regions is an interesting dilemma, and you have all of that geographic issue with that, and I'll talk about sample size or population size in a minute, and sometimes that can come out as well. What are the regions defined by state? That's a great question, and let me since we're talking about it, I am going to, so if I come over here to the Southeast, I thought there was a breakout over here, there's not. That's a great question, and there is an answer. We have a picture of it somewhere, and I'm sorry, I don't necessarily have that on me today. I will try to come up with that and put that picture inside of there. Interesting question, good stuff. But it gives you, like I say, we just need to get a definition of what the region is, and that's pretty easy to do. So I apologize for that, and we'll do that. Another thing that comes around with the data is what periods do these cover? And so I'm not making any judgments here, and I'm not trying to say which way is right and which way is wrong. I'm just trying to say here's different ways people use the data, and you can decide for yourself how you want to use it. The data collected is for fiscal year ends between April 1st and March 31st of the current year. So like I said, we just published the 2019-2020 edition. What that means is that from April 1st of 2018 to March 31st of 2019, any financial statements ending in that period was collected and put into this book. What does that really mean? That means that about March 31st, they have a month or two to collect data, and then they can analyze that data, put it together, and get it published by November 1st. Pretty short turnaround time when you think about it. It covers December 31st of 2018. Like I say, most of the statements inside of that particular area are going to be December 31st, 2018. Now, that said, the title of the book is here's our 2019-2020 edition. And so what years do you want to compare that against? You know, that's a matter of expertise. You get to decide. Do I take the latest book and compare it to my latest year of data? Do I move my book data back 1 year and compare it to December 31st of 2018? You get to decide that as the expert, but I wanted you to be aware that the data consists of statements between April 1st of the previous year to March 31st of the current year, or the first year of that data. And that's a pretty important item to know. So let me grab my pencil here. Okay. So what this is that this here is the spline of the book, and this here is going to be over on the left-hand side. Now this particular example is coming from cash flow measures. As I said, the RMA is about, you know, hey, I'm a loan officer. Am I going to get repaid? Let me talk about cash flows because that's the important part. That's how I get paid. But what happens over here is you get the asset size of the company. As I said, if you don't have enough companies in a particular slice, you don't get to see any data. So in this $2 to $10 million in assets, I get to see this data here. Sometimes there's a number over here that you can look at. It tells you that, okay, you know, in my particular coverage ratio, here's this number, or is there a certain number of companies that are being reported inside of there? You can look at that. You can tell what kinds of companies are in here based off of this. You know, here's the tax returns, here's compiled information, and you can get an idea. Are these mostly cash basis, or is it just, you know, other is going to mean it was prepared by the company? You can, okay, I have a question. Let me see if I can get to it. One of my cohorts out there was trying to give me a web link to say, here's how the the states are defined inside of there. So anyway, in the 0 to $500 million category, there was 4, 7, 16, 11, 1, and 5. That's how many companies are in this slice of industry. Then we break it down into asset sizes over on side of this. This middle part of the book is where, like I said, they are comparing all of that information against the last 5 years. Now, if I added this up right, there's more than 17 companies in this. So this is going back to the 2006, 2007 data and pulling up the information from that particular book and taking all of the industries and pushing that down. Let me clear these drawings and go to the next page. Okay. Grab my pencil again. So in this case here in the book, this is the spline. And as I move my way out, this is where the all PERT is. So you get the historical information. There's 43 companies in this particular slice of data in this particular year. So as I compare this to the previous years, I go from 43 to 46 to 20. This is that population size that I was trying to tell you about. So as you start to compare 20 companies to 43 companies, how much of a comparison do I really get to see? And that's one of the items that you get to look at with this particular data point is with this data set is that you can say, okay, if I'm looking at revenues and I'm seeing how much revenues grew from year to year, you know, I can get an idea of what the growth percentage of this industry is. But if I'm going in this case from like 17 companies up to 43 companies, am I seeing an apples to apples growth percentage on that? So you need to pay attention to that and see what's going on. As I said, over here is your sales slice. When you see another date up here, so that's only going through September 30th of 2010. I think this is 10, 11, I'm not sure. And so you may have data in here from that particular slice of data that, you know, only makes some sense because it's not a whole period. And you can see that inside of our data as well. And then as you get over here. So what I was trying to say before, let me clear off my data, is that you can't take a slice of data, in this case here, 25 million and over, and compare it to the whole industry. I think that that's a misnomer and you're missing all of the effects of this small company here. If you want to use all of the companies in the industry, then you use that column over there. If you want to use this slice of data, then you use that slice of data. One of the advantages of using the online editions of RMA, this is either RMA's edition or our edition, is that you can take each one of these slices and compare it to the previous year. Just like they're comparing this history to the previous years, you can take an individual slice and say 3 to 5 million against 3 to 5 million against 3 to 5 million, and you can see what that particular slice is doing over time, which is a good how do I want to say this? I think that that's a good exercise. I think that it takes a lot of time. I'm not sure how much information you get from that exercise other than you're trying to prove that the trend of the subject company was a little better than the trend of the industry for a particular area. If you're not worried about that so much, then maybe just comparing it to the most current year would work. Obviously, you're the expert. You get to decide those things, but I'm not sure how many times we ask that question. I think a lot of times we just go and say, oh, here's what everybody else is doing, so I got to do it too. So anyway, what's special about the Valuation Edition? So what we do with ValuSource is when they calculate all of these numbers, we've contracted with them to run an algorithm. And that specific algorithm takes each one of their data's points and slices it into 10 pieces. And so when we put it into 10 pieces, we're getting decile information inside of there. That's what gives us our p-tile rankings, our percentile rankings. And so, you know, I have inside of the slide deck here what that algorithm is, and you can see exactly how we go out there and do it. It's very transparent. And this information is exclusive to the ValuSource Valuation Edition. What does that mean to you? So here's the analysis. The average operating expense is 85%. The company's operating expense is 85%. This means the company is near average and the value should be near the average as well. No adjustment should be made to the cash flows or to the discount rate. Obviously, I'm putting some of my own words in there, but you get the idea. If you're using the standard edition, having an operating expense of 85% would mean that that's average. Half is above this, half is below this. If you're using the p-tile rankings, the 38th percentile is where the the company's operating expense is 85%. What that means is that 38% of the people have a lower ratio, 62% of the industry, the population that I'm comparing it to, have a higher ratio. Since operating expenses should be low, this company is better off in the industry and the value of the company should be higher. Therefore, the discount rate should be reduced. So what that means is that by putting this into percentiles, you can get an idea on an element by element basis where your company is riding. Now you're the expert. There's not some special aggregation tool here that says, oh, this company's in the 38th percentile. No, you're talking about specifically operating expenses. And when we get out there and I start showing you the data, you'll see that we can talk about, you know, profits. If there's profit before taxes of this, and that number should be high. Obviously, operating expenses should be low, and we can look at that. And so we can take a look at how that is. Anyway, my point I'm trying to make is that this p-tile, the way you discuss it, can have higher credibility, than just using the averages. And that's how you would do it. So what does this really mean? How do we go in here and calculate some of these things? And so, like I said, we go out, if this is the data point, whatever it is, we line that up from low to high. When we cut it in the middle, that is the median. And then when you cut that in the middle, that's going to be the high, the 75th percentile. And when you cut it into the low, that's going to be the 25th percentile. This is also known as the interquartile. Interquartile is another concept I don't think we give enough credence to in our world, and that says that half of the population is operating around that band. So, you know, your outliers here are obviously excluded, and you can say that this is, you know, where we want the norm to be. That's where the norm is. So when you're a loan officer and you're saying, hey, if I'm looking at a ratio, I come out here and that's where I want to be at. If I'm not in that normal range, I want to talk to the client and say, okay, why are your numbers so off here? Then I can make a decision as to whether that's going to hurt the probability of getting paid or not. Now, there was a question that says, why don't we have the average out here? The answer is that on the balance sheet and income statement, all you get are averages. You do not get a median. And then when you look at the ratios, all you get is a median and you don't get an average. And the reason for that is that the averages can be skewed a little bit. And that's what's going on with that. And so they've always presented it in that way, and that's how they're going to continue to present it. As I said, what ValuSource does is we come out here and cut this into 10 pieces. So when we cut that into 10 pieces, then we can say, okay, now we can figure out which piece of this you are in. Now this works really well too with other areas. So if you're looking at a market transaction set, you know, maybe you cut it into 4 pieces, maybe you cut it into 5 pieces, and you can do that. I have somebody trying to ask a question, so give me a second here to pull that up. So the data point, what does that mean? What I mean by this data point is that each element is on its own. So as I said, you get a common size balance sheet. So the percentage of cash to assets is a data point. The percentage of accounts receivables to assets is a data point. The current ratio is a data point. The debt to, net worth ratio is a data point. Each element, each data point stands on its own, and we go out there and we cut it into 10 pieces. That's what this data point means. And as you cut that into 10 pieces, you know, you can get an idea now of what the math is going on out here. Let's say you only have nine or 10 pieces inside of the data point, you cut that into 10 pieces. If there's only 10 observations inside of there and you're cutting it into 10 pieces, doesn't make a lot of sense to me, you know. Maybe seeing the median number would make some sense, the 50th percentile against the average, but you certainly aren't going to be able to see this, you know, this inner quartile here starts to get a little bit dicey when there's only 10 pieces inside of there. Man, you get 2.5 up here, 2.5 down there, but you get the idea. the larger that population is, the easier it is going to be to figure out this p-tile. Now you might ask yourself, how did I get from this decile information down into the exact percentile? And so let me come down here, erase some of my drawings, say that's simple linear interpolation. Linear interpolation is where we just simply go out and we say, okay, if we know that the difference between 40 and 30% is between 18 and 14, we can pick that ratio. Then we can say our subject number is here. So we go from our subject number down to the bottom. We could go up to the top as well. And then we pick a number inside of here and we go as X to that bottom number as that is up here. That's simply this formula. So you can go out there and do simple linear interpolation and say, okay, here's how I come up with my percentile. So I'm in the 38th percentile. We have analyzer tools that help you do that, calculate it for you, but it's simple to go back and calculate yourself. Like I say, transparency is something that we're trying to provide here. It's not a black box model. It's not something that you just say, oh, let me trust the computer. We don't want to be in that spot. We don't want to say just trust the computer. This is the algorithm that we use to get to those 10 pieces. And then let's talk a little bit about the math. And then as we start to look at some of these numbers, we can go forward. So you have the arithmetic mean. That was the average. As I said, the balance sheet and income statement are averages. When you add the averages, it will come to 100% of the assets and it will come to 100% of the revenue. You take all of the items, you divide it by the number of items, that's the arithmetic average. The example I like to use is if we took the charitable contributions of everybody in this webinar and figured out what that was, it's going to come to some number. Then if Bill Gates comes in and sits with us, all of a sudden that average is going to go way up to the high. Something we all are aware of. Outliers drive an average really high or really low. So you have to be careful of that. How do you get around that? The median. Well, the median says let's align these from lowest to highest, cut it in the middle. Half of the observations are above and half are below. What's the problem with medians? Medians ignore the volume. So in other words, if Bill Gates was inside of this room and we took the median, we might say that's more likely to be given by any individual member, but it ignores the idea that Bill Gates has given millions of dollars away this year. And so, you know, that millions of dollars is part of the volume of this, and it ignores that. That's what the median ignores, whereas the arithmetic average does not ignore that. So you have to be aware that both of those are measures of central tendency, but both of those have weaknesses and strengths. What I like to do is look at both of them and say, oh my goodness, if there's a big difference between these two, what's going on here? So if I have an arithmetic average, which is the case with my description in the report, is saying 85% is average. So if the arithmetic average is high, even though that median is lower, that means that one of those companies is driving that a little bit on the high side. And I can look at that and say, if there's a large skew in there, I can see what that is and tell myself, look, you know, we have to worry about the volume here as well as the number of items. So the question that should be rhetorical here is, what do you do if there's a large difference between the two? And I don't think many people consider that in benchmarking at all. A lot of times the data simply isn't there to do that in benchmarking. It's just that simple. So this is the data that comes out of here, and I will go into an example here in a moment. But this is the 85% I was talking about. And so, you know, I think somebody asked me about data points. Cost of sales is a data point. Operating expense is a data point. Operating profit is a data point. All others, profit before taxes is a data point. I just want to talk about operating expenses. If I look at the average column, it's 85%. When I come over here and I do my linear interpolation, it's going to drop down into this number inside of here, just a little bit below 40, or we calculated 38%. Why is that? Because the median is 91%, even though the average is 85. That means there's a lot more companies on this side of it than on this side. No, I got that. I might have that backwards, I'm sorry. But you get the idea, is that the average is not where the median is, and there's a discrepancy, a 6% discrepancy. So if we're looking at public accounting firms, obviously the dollars it takes to generate your cash flows is a big deal. Having a lower number here makes you more valuable. And so you can look at that. The other point I want to make on this particular screen is that just because it's in the low percentiles does not necessarily mean that it's a good deal. So on operating expenses, you want it to be on the low side. Profit before taxes, we want high numbers there. So we want to come over here and get on the high side. Here again, if we look at this 13.2% and we come over here, I'm guessing that that's going to be around the 62nd percentile, maybe 64th percentile. And you can get an idea and say, look, you know, this here is more profitable than 62% of the firms out there. So being in a low percentile or a high percentile isn't necessarily the whole story. You have to have context and say, where exactly am I fitting inside of here? This is the data that allows you to do that kind of empirical analysis. It's also easier if you have some spreadsheets and stuff that generate that information automatically. You can go through and recalculate it to make sure that the you know, that you're okay with that. But once you get it recalculated once, then you have a good idea that that's going to be the same way every time. You can rely on those numbers then to start to say, look, I'm in the 32nd percentile for good numbers. I'm in the 62nd percentile for high numbers. Works the same way for ratios. At this point, let me kick it over to the data set and real quickly kind of go through how we have this set up. So if I pick 1 year of data, I'm down here in 2015, I can choose my NAICS code either from a search or from a list. If I choose a list, all I do is drop this down, I go down my NAICS code. If I want to choose from a search, then I can type in the word certified, press search, and down here it'll give me the choices I have. Obviously, you know, I did that one ahead of time. When I do my slices, I can come over here and slice this by asset, sales, or historical. That historical is the columns coming across the middle of that. It has all of the observations inside of that industry in it. If I look at assets, I'm cutting it up by asset size. Now let me show you a cool thing. When you cut this up and you're looking at the $ balance sheets, where's my little drawer tool? All of a sudden now I look at my average net sales. I'm in 1.3 million. Even though I've cut this up into asset size, I might be able to use my assets to get an average revenue, average net sales, and see what that is on a $. That's the power of extending this out. Likewise, if I was using the sales slices and I really wanted to get closer to an asset condition, I'd come over here and I'd say, look, my average, you know, total assets, where's my little drawer tool? Getting excited now. My average assets is that number. And so I have another way to slice and dice this data and say, well, yes, I did slice this up by assets, 0 to 500 million, but the reason I did that is because the average assets in this side of here is $187,000. And I can do that by doing this, by doing it in this manner. Let me clear some of my drawings, get my mouse back. So once you start to figure out your slices here, you can say, okay, I'm going to go into sales. I want to pick 1 to 3 million, and I can see, you know, my income statement. We extend that over here. You get to see, you know, here's the number of companies that come through here. You get to see what the average balance. This here's the income statement. You get to see the common size, the deciles, averages, all of that's on that particular sheet. Let me click this off, go back to my mouse. If I come over to the ratios, I get to see all of the other information that's out there about the ratios. So as I said, you get high, 75th percentile, median, 50th percentile, 1.6, 1.6. You know, you might say, well, why does this say 1.3 and 1.4? I'm going to say it's rounding and cutting and trimming and stuff like that. But that's interesting, isn't it? That the data would actually be a discrepancy of that. Low, 25th percentile. And then you get the way we cut up that particular data for the ratios. As I said, if you look to sales to working capital, you know, that is a nonlinear formula. And when you put that information inside of there, it doesn't make sense. So don't use those particular numbers. You can tell, why would the 30th decile be 658, you know, and the 10th decile be minus 10? It's just not accurate. It doesn't make sense. So you have to be careful of that when you're looking at that particular data point. As I scroll down, I believe that you get to see the number of companies that were used inside of here. And so that information is available too. So if there's a discrepancy in the, I'm sorry, the number of companies is out here on the side. So in this case here for EBIT to interest, you know, there was 123 companies reporting, whereas in the other categories, it's 163. And you can get an idea of what's going on inside of that information as well. As I said, these NAs, that means that there's not enough information here to calculate it. Sometimes you'll see this 999 or minus 999. If you look at the ratio and you have sales to net fixed assets, so what this really means is this is a very large number. So net fixed assets is going to be $1 and sales is going to be 400 million trillion dollars. And so it's going to drive that number to 999. That's what's going on with those particular numbers. Again, that's in the front portion of the book. Be happy to send all of that to you guys. Once you get all of this done and you've looked at your working pane, like I say, you know how to cut this up over here, then there's two ways to get the data out. The first is to click on the data only, and the second is to click on the analysis. The data will just give you these worksheets that are up here. The analysis will allow you to type in the subject company's data and actually do that p-tile analysis and say, here's where I'm at from the viewpoint of the subject company. So there is an analyzer tool that will help get you to that spot. There's also a way to download this into the software where it does the same sort of thing. It calculates the percentiles and tells you where you stand inside of those percentiles. Obviously, if you're below the 10th percentile, we don't know how far below. If you're above the 90th percentile, we don't know how far above. So it just says that you're inside of there. The next few slides in the slide deck just tell you what I kind of went through. Exports at the bottom. Here's the software where you can see that the the p-tiles are inside of here. So if it's over the 90th percentile or under the 10th, it has no real meaning other than saying, look, I'm very much on the extreme end of the values inside of here. And so you probably have some issues with that as a evaluator. 82nd percentile here says, hey, I'm pretty profitable with the 7.81. And I'm not sure I'm even comparing apples to apples over here. It just is, so you can get an idea. But it does download into the software automatically. You can get that information and see what's going on with it inside of the software. Obviously, what we're trying to do there is make it easier to use than others. So let me come back to my questions here. So for the balance sheet items that only have averages, can you cut it into p-tiles in your database? And the answer is yes. I believe that I showed you that. Let me go back over to the website. If I go over to the balance sheet, let me pick up my drawing tool here. So in this case here, if I was looking at inventory, what's the average inventory on a balance sheet? This is ending inventory, by the way. It's not an average beginning of year, end of year. It's end of year. I can tell that, the first deciles over here are zeros, but in the 90th decile, there's one over here at 9.8%. And so, in a CPA firm, obviously there's not a lot of inventory, but you could look at cash and cash equivalents and see what the p-tile information is there. So absolutely, we take that, you get to see the median is the 50th percentile, and you can look at that. Let me see if I can go back to my, okay, questions. Are you Ken Miles' son? Interesting question. So the last time I talked to him before he passed, we went back in our family trees 4 generations. In case you were wondering, well, I'm sorry, this is Ken Miles. I thought you were talking about Ray Miles. No, I'm not Ken Miles' son, and no, I'm not related to Ray Miles of the IBA either. So anyway, so that's how that goes. As I said, before Ray passed, I went back 4 generations in our family tree with him, and there was no crossovers. It just happens to be coincidence that we have the same last name. And let me come over. I thought there was a chat question here. There's 2 places for me to get this. So can you elaborate 12 months trial 3? I'm not sure what that means. Yeah, I'm not sure what that means. I can see the person's name here, and I'm just going to say, you know who I am, give me a call, give me an email, and I'll be happy to elaborate on that. So is there a trailing 12 months figure? And the answer is no. These are financial statements where the ending periods happen between April 1st and March 31st. So I'm assuming it's a 12-month financial statement ending period. Maybe that's a bad assumption on my part, but there is no such thing as a trailing 12 months. That's for all of the 12-month periods ending in that period. And so a trailing 12 months would make no sense to put inside of here. So are there other questions here? Let's see, there might be a couple more. Can your software plug into our Excel models? And the answer is yes. There's two ways that this works. The first is that if you pull out that an analyzer tool and drop it down, that is Microsoft Excel. There's no macros on the RMA piece, and you can certainly just copy and paste that into whatever models you're using. The other way is that, and I think this is kind of outside of the scope here, but I'm going to mention it, our software is based off of Microsoft Excel. If you have a model inside of Microsoft Excel, it will work inside of our software. It's a very, very, very rare case when it won't. And by that, I mean, you're going to have some special coding that's mixed around it. But if you're doing this on an Excel spreadsheet, and it works on two different computers, I'm sure that our software will be able to do it. And the advantages of our software is that automates that process and it standardizes it, which means you have better quality control over work product. Again, like I say, I don't want to get into it here. I enjoy talking about all these things. Feel free. I think I'm going to leave this up with my name and email on it. And let's see, are there any more questions before I do that? Anyway, I'll make sure that my email is up, and let's see, where am I at? Oh, yeah, there it is. So I will leave my email up, and you are welcome to reach out to me. I enjoy talking about these things. You can connect with me on LinkedIn. And like I say, nothing's perfect out there. Hopefully you got an idea of saying, oh, here's RMA. Here's how they're cutting that up to make my analysis a little stronger, a little more credible. Nothing's perfect. And if you want to talk about some of these other databases, I can tell you what knowledge I have of them, and you can go out there and make your own choices. I want to thank you very much for spending an hour with me today. Hopefully you learned something, and like I say, it's been a pleasure. So I'm just going to leave this up for a minute, and we'll go from there. Thank you.